Hi everyone, in this video we'll be starting with the chapter number 13 of CMT level 2 multi-candle patterns. Before watching this video, make sure that you've checked the single candle patterns. If you haven't, then check the playlist link in the description box below and watch all the previous chapters, and then you can come back to this. So in this chapter we'll talk about multiple candlestick patterns. Like we'll take a cluster of candles together and join them together and create a pattern out of it. Like in the previous chapter, we saw individual candlesticks. Now we'll be seeing a group of candlesticks. It's going to be a very easy and a simple chapter because most of them you will be familiar with because you've done them in CMT level 1. So let's start with the section 1, and this talks about close cousins, which has piercing, dark cloud covers, engulfing, and counter attacks. Candle charts are most powerful when two or more candle lines combine in a candle pattern. Just as the Japanese endowed single candle lines with imaginative names, they also best out colorful descriptions on candle patterns. These descriptive monikers underscore the nature of pattern signals. For example, dark cloud cover. The dark cloud cover is a bearish signal and it consists of two candle pattern that indicates a top reversal. Of course, when dark clouds cover the sky, it is a warning before the storm. In this unit, we'll discuss patterns that include two or three candle lines. We'll also discuss windows, which the Japanese call disjoint candles. The section that follows explains dark cloud covers and engulfing, piercing, and counterattack patterns. Readily recognizable on the charts, these candle patterns offer potent signals of possible trend changes and reversals. Use them in conjunction with indicators. So, obviously, whatever you're learning, make sure to combine it with other factors like indicators or price action, like support and resistances, volumes, and so on. In earlier units, we learned about the power of single candle lines. Now we'll discuss why multiple candle patterns display even more intense signals. Just as individual candle lines send important signals about the market's health, two and three candle patterns that emerge during uptrends and downtrends often presage a trend reversal or change. Typically, a two candle pattern begins with the topping or bottoming candle. The next candle confirms the reversal. A three candle pattern may start with the formation of a candle in context of a trend, followed by the topping or bottoming candle. The third candle is appearance, which verifies the reversal signal. We'll discuss the two candle pattern referred to as the bullish piercing pattern. Figure 13.1, let's see that. Okay, so this is how a piercing pattern looks like. Downturn is going on, downturn is going on, the last red candle, and then suddenly you have a green candle. This is a piercing pattern. Piercing pattern. Now, dark cloud cover is the opposite of piercing pattern. Uptrend is going on, and suddenly there's a normal white candle, and then there's a black candle which covered almost three-fourths of the last candle. Even here, you can see three-fourths of the last candle has been engulfed. So that is what is the piercing pattern, and this is what is the dark cloud cover. An easy way to remember these patterns is just remember what a dark cloud is. And dark cloud is basically the clouds get dark right before a storm, which means right before a downtrend is starting, right when the uptrend is going to end, there is going to be a dark cloud. And the opposite of dark cloud is piercing pattern. It's that simple. Bullish piercing pattern appears in the context of a decline or downturn. Naturally, the more oversold the decline, the more significant the signal may be. The bullish piercing pattern consists of a black body forming in a downtrend. The next real body culminates in a white real body that closes within the prior black body, preferably more than one half of the black body's length. We saw that. The white real body pierces the recent downtrend, with bulls overwhelming the bears. Subsequent price action should confirm the pattern. You might expect the counterpart to be bullish piercing pattern to be called a bearish piercing pattern. However, the opposite pattern is a powerful top reversal known as dark cloud cover. So yeah, it's not called a bearish piercing pattern, it's called a dark cloud cover, but obviously means the same thing. Then we have a dark cloud cover, which we saw, the second one. The first session should be a strong white real body. The second session's price opens over the prior session's high. By the end of the second session, it closes near the low of the session. The black candle should ideally close below the center. Okay, so you can also see this. This candle opens below the low of this, and this candle opens above the high of this. This foreboding pattern graphically indicates that the bears constrain the bulls. If the black real body does not close below the halfway point or prior white candle, consider waiting for the bearish confirmation in the following session. This could be lower uh, close on the next session. Here's an example of how candle patterns add to your money management skills by giving early warning of trend change. Obviously, you can use these patterns even to exit a position which you are in currently, right? Where do you book your profits? So you can wait for these kind of patterns. If you were holding a long position of a security in an uptrend and you saw the strong white real body of the first candle soaring into an uptrend, you would surely remain bullish. On the next session, the security opens at a new high, confirming your bullishness. But by the end of the session, the price has fallen well within the prior session's body, indicating that new price high failed to hold, and supply basically is more powerful than the demand. What is that? That is again the dark cloud cover. At this point, your bullishness may change to caution, and your wisdom tells you to take profit. This is a prime example of how candle signals offer early reversal and can aid you in locking in your profits. Next, we'll understand two candle patterns called bullish engulfing, which is in 13.2. Let's go to 13.2. Okay. Engulfing pattern obviously just engulfs the previous red candle completely. The body engulfs the entire wick as well as the body. And a bearish engulfing also is just the opposite. The big black will engulf the entire candle, including its wicks and bodies. Okay, the market falls. Again, this is again very simple. I don't have to discuss what an engulfing is. You know what an engulfing is. Where do you keep a stop? Now, if I'm taking a buy from here, I'll enter above the high of the engulfing pattern, stop loss below the low, and aim for a target. If I'm shorting using a bearish engulfing, enter below the low, stop loss above the high, and aim for the lows. The flip side of a bullish engulfing pattern is the bearish engulfing patterns, which appears at the top of the market. I don't have to discuss this. I think you know that. Okay. Now let's see what are counter attack lines. Counter attack lines are formed when opposite colored candles have the same close. The bullish counter attack line. Okay, let's see 13.3a. Okay, now these are counter attack patterns. Now these are something new which we're going to learn rather than the basic engulfing and stuff like that. Look at the bullish counter attack. There's a downtrend going on, okay? And you can see that the opening of the previous candle and the closing of the next candle is the same. So when the bullish candle closes at the opening of the previous bearish candle, it is a bullish counter attack pattern. Similarly, when you talk about bearish, when the closing, oh sorry, when the closing of the bearish candle is right at the closing of the bullish candle. Okay, let's just quickly revise. Basically, in a bullish counter attack, you have a green candle. So the closing of the green candle is at the closing of the red candle, which was prior. And in a bearish counter attack, what happens is that you have a red candle, and the closing of the red candle is right at the closing of the previous green candle. Okay, now that is what is the bearish counter attack and the bullish counter attack. Now let's come to the section 2, and here we'll be learning about the Harami cross, morning and evening stars. In this section, we're going to discuss more candle patterns that are formed by combining by a combination of single candle lines. First, we'll look at an interesting two candle pattern called the Harami and a variation on this pattern known as a Harami cross. Then we'll delve into a powerful three candle pattern. Okay. In previous sections, we talked about single candle lines called spinning tops. These small real lines are components of the reversal pattern referred to as the Harami, as shown in figure 13.4. Okay, look at this bearish Harami. So there's an uptrend which was going on, and then you have a big green candle, and then you have a small red candle which is completely engulfed inside this. Now, there's another way to imagine or remember the Harami pattern. Just imagine a pregnant woman or a woman who is carrying a baby. So this is the woman, and here is the baby. So the way you can remember is that it is just the opposite of engulfing, but it is also looking like a woman with a baby within herself, right? So that is the way you can remember the Harami pattern. So whenever you think about a bearish Harami pattern, it is when there's an uptrend going on, and after the last green candle, a red baby appears. that is confirming a bearish harami pattern. In a bullish harami pattern, there is a downtrend going on and there is a red lady with a green baby, and then the price might go up. That is a bullish harami. So that is what is a bearish harami and a bullish harami. Now, what is a harami cross? That is something you need to keep in mind. Let's talk about that. On the other hand, when a bullish harami appears in an okay, this we've discussed the bears. Where is it? Do you understand how this pattern tells you an important story about market environment with its accompanying change of sentiment? If the second real body is a doji instead of a spinning top, it is called a harami cross. Okay. Here we have a spinning top. Spinning top is basically indecision candle, right? But instead of an indecision candle, if you have a doji, then in that case it's called as a harami cross. Simple. Look at this. Instead of a normal spinning top, we have a doji here. We have a doji here. So here we'll have cross. Just a second. Counter attack. We've done counter attack. Closing is just the same in counter attack. All right. Okay. Next, we'll discuss an intriguing pattern known as the star. Indeed, this pattern is a star when it comes to calling top and bottom reversals. A star is a small real body, think of a spinning top, that gaps away from the long real body preceding it in an uptrend or downtrend. The third candle in the formation also should gap away from the real body of the star, leaving the star's real body isolated at the top or bottom. Basically, a morning star and an evening star. Let's quickly see that. So there's a downtrend going on, then there's a black candle, then there is an indecision candle, and then there is a green candle. This is a morning star. The going up green candle, small red or white candle. This is an evening star. And if you have a doji instead of that spinning top, then you know it will be called a morning doji star or an evening doji star. I'm not going into the detail of it. It's very simple, and we've done it in level 1 as well. Okay. Okay. Now let's see what are tweezers, crows, and soldiers. In this section, we'll continue to explore interesting candle patterns that tell us more about the mood and manner of market environment. Although the recent price action of a chart is important, earlier price action can also contribute to our assessment of future price movement. The stories candle patterns tell us, present and past, all add to our ability to evaluate potential opportunities that will contribute to our success. Okay. The candle patterns known as tweezers consist of two or more candle lines with matching highs or lows. The name is derived from their formation. The tweezer stop occurs in a rising market when two or more consecutive highs match each other, thus giving the image of two prongs or tweezers. How does a tweezer look? They have two which have the same highs, right? So that's what they're saying. Let's see tweezer top and hanging man. This is a hanging man and a tweezer top. Now, what's the point over here? They both have the same low, right, and the high. Let's say tweezer top and harami. They both have the same high. Tweezer top and dark cloud cover. They both have the same high and low. Tweezer top and hammer. Same low. Tweezer bottom and harami. Same low. Tweezer bottom and piercing pattern. Same. So a tweezer bottom takes place in a declining market when two successive lows are equal. When lows are equal, it's a tweezer bottom. When highs are equal, it's a tweezer top. When highs are equal, tweezer top. When lows are equal, it's tweezer bottom. Okay, what is the three black crows? Let's see this. Three black crows when you have three big black candles and none of them are inside any bodies, they all are extending below. Same way, three white soldiers is when you have three like this. Simple stuff. I'm not getting into the detail of it. You know the psychology behind it. Now let's come to disjointed candles and let's start with rising and falling windows. In previous sections, we've studied reversal patterns. These patterns have suggested we take action. whether to open a new position or apply money management rules to close a position. Now we are going to explore a Japanese continuation pattern that implies that prior trend will continue. This pattern is called a window, synonymous with the Western pattern known as gap. You know that whenever we talk about windows, we're referring to gaps. We've also done this in the level 1. Now let's start with it. In technical analysis, we generally talk about two kinds of patterns, reversal patterns as well as the obviously continuation patterns. By now, you are familiar with the action that takes place in reversal pattern, meaning a change of direction. If you are a trader, you spend the majority of your time assessing the charts and looking for potential trend reversals. That is where you typically enter and exit the positions. Continuation patterns suggest the trend before the pattern will continue, whether up or down. A window is same as a western gap. For example, stock XYZ has a high of 50. If the low of the next session is 52, there is a 2 rising window, obviously. So that's basically a gap of 2 rupees, right? $2. If, however, stock XYZ has a low of $50 with next session's high at 48, we would say it has gap down 2 and therefore 2 falling window exists. Falling window is basically a gap, right? A gap down is a falling window and a gap up is a rising window. A rising window is a bullish signal. The price vacuum between the prior candle's high and the current session's low means that bulls are in control. Obviously, a gap up is a bullish signal, a gap down is a bearish signal. So there's a Japanese advice that you need to go in the direction of the window. If there's a gap up, then only look for buying opportunities. If there's a gap down, only look for selling opportunities. For a quick demonstration of how gaps can be filled on an intraday basis, watch a stock that gaps up a point or more at the open. Since some market professionals, okay, read this. Sometimes, yeah. So what happens is that if the market opens gap up, then the price comes down, fills the gap, and then continues going up. So that is something which keeps happening. But don't trade in the direction of filling the gap. But just keep in mind that such a possibility can happen. So maybe you can wait for the price to eventually clear the gap, and then you can enter into the position. So that's the only reason you need to know about it, and it's not for you to trade to take a trade to fill the gap. That isn't something you should be doing. One of the most common misunderstandings about rising and falling windows is identifying the part of the candle session that constitute a price limit. Some think that if real bodies do not touch, the space between is a window. This is incorrect. With rising and falling windows, there must be a space, whether narrow or wide, where candle highs and lows don't interact. So if shadows intersect, there is no window. So even the shadows should not intersect. So it should be like this. This low has to not touch this. Even the shadows should not touch. Only then it is known as the window. When a rising window occurs, the entire space of that window is considered support area. Therefore, if you have a long position that just developed a rising window, you can expect that window to act as a support, and the market might come retrace from the gap and or from the window and go up again. If the price retraces to the bottom of the window but does not close below it, then supports has not been broken. But if the candle closes below the window, that means that now the direction has been changed. Look at this: rising window, falling window. Simple stuff. And for falling window, it's just the opposite. If a candle closes above the window, then again direction has been changed. So that's it with this chapter. I hope you understood it.